Right now, as you listen to me, there is a class of American family walking around with the wrong map in its head. It is not a reckless class. It is not a lazy class. It is not a foolish class. It is the middle class, and in many cases it is made up of the most responsible people in the country. They went to work. They paid their bills. They borrowed the way the system told them to borrow. They bought the house when rates were low enough to make the monthly payment feel manageable. They financed the car because that was how adults did it. Now they put expenses on the card because inflation rose faster than paychecks, and the difference had to come from somewhere. They trusted that rates would eventually come back down, that inflation would cool, that housing would become easier, that the Federal Reserve would find a way to make the system comfortable again. That trust is the trap. I want to be precise about what I mean because people hear a phrase like interest rate trap and they imagine a technical problem that belongs to economists, bankers, and people in dark suits who enjoy speaking in acronyms. It does not belong to them. It belongs to the household. It belongs to the family whose mortgage rate now changes the way they think about having another child. It belongs to the worker who opens the credit card statement and feels that strange mixture of embarrassment and fatigue because the balance is not there because he was irresponsible. It is there because groceries, insurance, utilities, and fuel move faster than his wage, and he papered over the difference month by month. It belongs to the homeowner sitting on a low fixed mortgage who cannot move even if the school district, the job market, or the family situation says moving would make sense. Because selling means stepping into a new mortgage world that no longer makes mathematical sense. It belongs to the young couple doing everything right and still finding that the house they could have afforded 3 years ago now requires an income they do not have and may not see for years. That is the interest rate trap. It is not just a high rate. It is not just debt. It is debt built in one monetary climate and serviced in another. That is what makes it deadly. A great many people think the problem with debt is simply that there is too much of it. That is not quite right. Debt becomes dangerous when the assumptions under which it was taken on stop matching the environment in which it must be repaid. Cheap debt feels manageable. Expensive debt feels punitive. Cheap debt rolling into expensive debt is how stable. Looking lives get turned into monthly anxiety. That is exactly what has happened. The accumulation phase always feels like prosperity while you are inside it. That is why people never recognize the trap while it is being built. Low rates make everything feel rational. A larger mortgage feels fine because the payment still fits. A car loan feels acceptable because the monthly bill is not yet offensive. Revolving credit feels temporary because next year ought to be better. Home equity feels abundant because the house keeps rising in value and everyone around you speaks as though appreciation were a law of nature. That is how traps are built. No one walks into them if they are labeled clearly. They are built with reassurance. They are built with the language of normalcy. They are built with phrases like historically low rates, affordable monthly payments, transitory inflation, strong consumer, soft landing, resilient economy. I have spent too much of my life around capital markets not to recognize the pattern. Systems do not usually collapse when everyone is afraid. They become dangerous when comfort has lasted long enough to turn leverage into common sense. That was the first phase. The second phase came when rates rose fast enough to snap the mood but not fast enough to clear the system. That is the cruel middle ground the Federal Reserve had to respond to the inflation it helped create. And once it did, the same families that had been encouraged to optimize around low borrowing costs discovered the cost of money was not a background setting. It was the whole soundtrack of their financial life. Mortgage affordability collapsed. Credit card interest became predatory in practice, even when legal in form. Auto loans moved from irritating to absurd home equity. Borrowing stopped looking clever and started looking expensive. Suddenly, the difference between fixed and variable rates became the difference between manageable and suffocating. This is where the trap snapped shut. The middle class did not respond to that snap by reducing debt quickly, because most families cannot reduce debt quickly when the same inflation that forced rates higher is also eating the breathing room out of the paycheck. They did what people always do when they are squeezed but still trying to remain respectable. They stretched, they delayed, they rolled balances, they used one form of credit to buy time against another. They postponed the repair, they skipped the contribution, they stopped building savings, and began funding normal life with tomorrow. As money that is stage 3. Paralysis. This is the stage we are living through now, and it is the most deceptive. Because on the outside, life still looks recognizable. Stores are open. Offices still function. Paychecks still arrive. The damage is not theatrical. It is cumulative. The trap is fully closed at this stage because rates are still too high to make the debt easy. But inflation is still too alive to let policymakers bring rates low enough to rescue everyone. The Federal Reserve can no longer behave as though its choices are clean. Cut too aggressively and inflation returns with fresh confidence, especially with oil pressing on everything from transport to food. Stay high and more households crack under the accumulated burden of balances that were never meant to be carried at these rates. For this long, raise rates again, and you risk detonating the weakest parts of the housing and credit system at the exact moment the government itself is staring at refinancing needs too large to ignore. There is no comfortable direction. That is why I call it a trap. If there were a painless exit, it would not be a trap. It would be a policy problem. A real trap is a condition in which each available path creates a different wound. That is where the American middle class sits right now. And this is the point that almost no politician will say honestly. The middle class is not being squeezed by accident. It is being reset by arithmetic. The old financial model of the American household depended on three things staying true at once: cheap money, rising asset values, especially housing, and a labor market strong enough to keep the debt service ratio tolerable even as the debt stock rose. Two of those have broken. Money is no longer cheap. Housing is no longer broadly accessible. And the labor market, while not yet collapsing outright, is no longer strong enough to keep millions of households from feeling that they are one bad month away from trouble. That is enough. You do not need a depression headline for a reset to begin. You only need enough households running out of margin. Margin is the word people should be using more often, not optimism, not vibes. Margin, how much room exists between what a family earns and what a family must pay to keep the structure of its life standing. Most middle-class damage does not happen because income disappears entirely. It happens because margin disappears first. And once margin is gone, every small event becomes a financing event. A flat tire becomes debt, a medical bill becomes debt, a school expense becomes debt, a broken appliance becomes debt, a temporary drop in hours becomes debt, and because the debt is being carried in a high-rate environment, the debt itself becomes a machine that manufactures the next problem. That is what people miss. Debt is not just a bill at these rates. It is an active drain on future optionality. It narrows your next move before you make it. It takes a dollar that could have become savings or investment or freedom and redirects it into keeping the past alive. This is why the 2026 reset matters so much. Most people think a reset means some government program, some official event, some clean before and after line. It is not like that. A real reset is organic. It is what happens when too many balance sheets can no longer coexist with the interest rate environment around them. Some people default, some sell, some quietly shrink their life, some move back in with family, some postpone children, some postpone retirement, some never recover the years of compounding they lost because every spare dollar went into servicing a past version of themselves that borrowed under different assumptions. That is the reset. Not one big bang. Millions of private concessions. You can see it coming if you know what to look for. Rising delinquencies matter, but the more important thing is where they rise first. Every serious debt crisis starts at the margins and works inward. Lower income zip codes crack first because they have less room, then the lower half of the middle class, then the households that look safe only because the old environment made their ratios look acceptable. By the time the center admits there is a problem, the edge has already been suffering for months. History is merciless on this point. In the 1970s, the middle class was not destroyed by one cinematic event. It was worn down by a decade in which inflation outpaced comfort. Wages failed to keep pace. Mortgage rates became prohibitive. And savers discovered that nominal security and real security were not the same thing. The cruelty of stagflation is that it denies everyone the dignity of a clean explanation. If you lose your job in a crash, at least the cause is obvious. In stagflation, you keep working and still feel poorer. You keep earning and still move backward. You save and still lose purchasing power. You act responsibly, and the system quietly punishes you anyway. That is why the 1970s still matter. Not because history repeats exactly, because it rhymes where it hurts. The comparison to Japan matters too. Though for a different reason, Japan showed that once debt reaches a certain scale, even aggressive policy support does not guarantee a return to healthy demand. Why? Because heavily indebted households and corporations do not treat stimulus as liberation. They treat it as a chance to keep repairing damaged balance sheets. The money never becomes vibrant growth. It disappears into the old hole that is balance sheet recession logic, and it can turn an economy from merely fragile to eerily flat for years. If you want to understand why middle-class households now feel stuck, understand this. They are not just trapped by high rates. They are trapped by the possibility that even if the Fed eases more eventually, much of the relief may arrive into a household sector too burdened, too cautious, and too scarred to spend freely the way it once did. Debt changes behavior. Long periods of financial stress do that. A family that has spent years one emergency away from trouble does not bounce back into confident consumption overnight. And then there is 2008, which taught the country another brutal lesson. Adjustable debt kills slowly and then all at once. It is remarkable how often people tell themselves that this time is different because the product names have changed. The names do not matter. The structure matters. If a household took on obligations assuming one interest rate regime and must now service them in another, the same underlying mechanism is at work. The product can be a HELOC, a floating loan, a revolving card balance, a reset mortgage, a finance vehicle, or some combination of all of them. If the monthly cost rises while the household's margin was already thin, it is the same movie with updated furniture. This is why I reject the lazy way people talk about the middle class. They speak as though the problem is discipline. Sometimes it is. But much of the time the problem is sequence. Debt was accumulated under one set of assumptions and repriced under another. The household did not need to be reckless for the math to become ugly. It only needed to be typical. That is a frightening thought, and it should be. The most dangerous crises for the middle class are the ones in which average behavior becomes structurally unaffordable. That is where we are. Now, housing makes this worse, not better. For generations, home ownership was the middle class's great wealth engine. It was not perfect, but it functioned. A household that bought prudently, held long enough, and stayed employed had a decent chance of building equity, stability, and a base from which the next generation could begin slightly further ahead. That mechanism is now malfunctioning. If you already own with a very low fixed mortgage, you are not necessarily happy. You are simply locked in. Selling makes no sense because your replacement housing cost would be much worse. So you stay, and because you stay, inventory remains thin. Because inventory remains thin, prices do not fall enough to restore affordability, and because prices do not fall enough, would-be buyers remain locked out even as the market itself feels sluggish and unhealthy. This is the worst kind of market. One in which sellers cannot move, buyers cannot enter. And the asset around which middle-class wealth was historically organized no longer performs its old social function. That is what people mean when they say the ladder has been pulled up. Though I think the truth is even harsher. The ladder is still there. It is simply priced at a level the next climber cannot reach. That matters for net worth. It matters for family formation. It matters for geographic mobility. It matters for labor flexibility. It matters for political rage. And it matters because once the traditional wealth building asset stops working for the next cohort, debt starts trying to impersonate wealth. That is exactly what is happening. Credit cards are not building wealth. Auto loans are not building wealth. HELOCs drawn to cover rising living costs are not building wealth. Student debt tied to labor markets that cannot justify the burden is not building wealth. These are not bridges to a better future when carried at scale in this rate environment. They are claims on future income that narrow the future before it arrives. This is why I think the statistic people should care about most is not the size of total household debt by itself. It is the share of disposable income now consumed by debt service when the cost of essentials is still too high and inflation is no longer fully cooperative. The average is not the truth. The lower half of the middle class is living far above the average burden. And those are the households that teach you the real condition of a country long before the broad averages look terrifying. They are already teaching it now. Now, I want to say something practical because analysis without decision is a luxury item, and most households no longer have the luxury of passively admiring the problem. The first priority in an interest rate trap is not optimization. It is de-risking. If you carry variable rate debt, that is the enemy, not in a rhetorical sense. In a mechanical sense, high-rate revolving balances do not forgive. They do not wait. They do not care if your stress was understandable. They are a siphon. Every month you carry them is a month the system taxes your weakness at a premium. The cleanest move, the least glamorous move, and the most necessary move is to attack those balances without sentiment. Credit card debt, variable rate personal balances, HELOCs, that were tolerable at one rate and ugly at another. Any structure that breathes with the Fed and breathes against you. This is not the part of the story people like to hear because it is not exciting, but it is the line between the 84% who get processed by the reset and the smaller group that navigates it. No one out earns a trap like this casually. You have to change structure. The second priority is liquid cash, not because cash is an investment, because cash is the only thing that lets you absorb a shock without immediately converting it into fresh high-rate debt. A 6-month reserve in a normal environment sounds conservative to people who worship optimization. In this environment, it is an aggressive position because it breaks the chain between surprise and debt. That chain is where middle-class households are now getting strangled. The family with liquidity is not richer in a glamorous sense. It is simply harder to force into the next bad decision that matters enormously. The third priority is honesty about what you can actually afford in this new world. A lot of people are still making decisions based on the emotional residue of the low-rate era. They keep looking at houses as though affordability will soon revert. They keep treating large financed purchases as though temporary rates are the only thing standing between them and a normal middle-class life. They keep assuming that the American dream is delayed rather than repriced. Some of it may eventually ease. But arithmetic does not care about hope. In the meantime, a home bought at today's rates and today's prices with fragile margin and little reserve is not a wealth strategy. It is often a vulnerability purchase with patriotic marketing. That is especially true if the buyer is stretching because everyone in his social circle still talks as though ownership itself guarantees wisdom. Ownership never guarantees wisdom. It only magnifies the wisdom or foolishness with which it was acquired. The fourth priority is understanding the silent inflation tax on savings. This is another place the middle class gets hit twice. First through expensive debt, then through complacent cash. If your savings earn nothing while inflation takes a meaningful bite, your emergency fund is slowly being hollowed out. That does not mean you swing for yield and take foolish risk with money meant for safety. It means you respect the difference between dead cash and cash that is at least trying to defend its own purchasing power. That is a subtle point, but it matters in a stagflationary environment. Now I want to return to the phrase that gives this whole story its emotional weight. 84% will not survive the trap. Whether the exact number proves right or wrong in retrospective academic terms is less important than what the phrase is trying to capture. It is trying to capture that the majority of middle-class households are not built for this rate environment, this inflation environment, this housing environment, and this debt mix at the same time that I believe is true. Most households were built for the world before 2022 and kept behaving as though that world would soon return. It has not. That is the heart of the reset. The people who come through periods like this with their dignity and optionality intact are not usually the ones with the highest income on paper. They are the ones who recognize that the environment changed and then allow that recognition to change their behavior before the statistics become front. Page panic, they reduce the wrong debt, they stop reaching for symbolic purchases, they build cash, they stop confusing lifestyle maintenance with financial strength. They understand that if the old world is gone, the old assumptions must go with it. That is hard for people. It feels like admitting defeat. It is not defeat, it is adaptation. And adaptation always looks pessimistic to people who are still living off yesterday's rules. I have watched enough cycles to know that. By the time the broader culture admits a reset is happening, the households that adjusted early already look calmer, more liquid, less cornered, and more capable. That calm is not an accident. It is purchased. It is purchased with uncomfortable decisions made before everyone else was ready to make them. That is what this moment is asking for. Not panic, not ideology adjustment. If you are waiting for politics to rescue the middle class cleanly, you are waiting for a form of honesty that democratic systems under debt stress rarely produce. If you are waiting for the Fed to engineer a painless exit, you are asking one institution to simultaneously protect growth, defend the currency, tame inflation, stabilize housing, and relieve debtors. That is too much to ask. The real question is smaller and more personal. Will your household be one of the households that updates its structure in time? That is the only version of this story you actually control. Not the oil price, not the next dot plot, not the rhetoric from Washington, your structure, your leverage, your liquidity. Your honesty. That is the edge. And in an interest rate trap, the edge is everything. 20 years from now, economists will give this period a name that makes it sound inevitable. They always do. They will explain the stages cleanly. They will chart the debt growth, the rate shock, the paralysis, the reset. They will treat the suffering as if it were obvious from the numbers. It is obvious from the numbers. What is not obvious is whether people living through it will respect what the numbers are already saying before the consequences force the lesson onto them. That is why I wanted to speak plainly. The trap is real. The window is measured in months, not years. And the households that survive it best will not be the households that kept repeating the old script with more optimism. They will be the households that understood the script had already changed. That is what the 2026 reset really is. Not a mysterious event, a brutal rewrite of what middle-class stability now requires